Not only are we more insulated during the down periods, but when the market is hot, okay, and you're in these high growth periods, this is where you get the better returns too. It's kind of like a win-win.
Welcome to the Freedom Point Real Estate Podcast, where we talk about creating more time freedom through passive real estate investing. Passive investing in real estate challenges conventional investment wisdom. We are passionate about learning and sharing resources with others who are ready to transform their investing mindset. Quick disclaimer as always, I am not a CPA, I am not an attorney or a financial advisor. This is not financial advice, not telling you or anyone else what to do. The views and opinions expressed in these podcasts are provided for education and informational purposes only and are not necessarily the views of my employer, ADP. I'm glad you're here. Now let's dig in. All right, welcome back, Freedom Point Podcast listeners. Thank you again for jumping into another episode of the Freedom Point. We're so glad you're here with us today. Really appreciate you joining in. I've got an awesome guest with me today, the one, the only, Zach Haptonstall. Zach, welcome to the show.
Yeah, thanks so much, Jeremy. Really excited to be on the show here. And I know it's a long waiting list, so I'm happy to finally make it on.
Yeah, absolutely. Appreciate it. By the time we get this episode published, I think you'll be pretty close to episode 100. So my apologies for the delay.
No, I would love it if I am exactly number 100. So I appreciate it. Thanks, Jeremy. Happy to be here.
All right, sounds good. Well, just a quick bio on Zach for those that might not know Zach. He is the CEO and co-founder of Rise48 Equity, Rise48 Communities, and Rise48 Construction. Zach's main responsibilities as CEO include overseeing all acquisitions, sourcing capital, and building strategic partnerships. Since 2019, get this, Rise48 Equity has completed over $2 billion in total transactions. Zach resides both in Scottsdale, Arizona, and Dallas, Texas, with his wife, Grace, and their growing family. Zach, why don't you provide our listening audience a little bit more about kind of your background? You went from, X to Y. Obviously, you've built a very successful real estate, equity company over the course of the last, several years. Maybe explain to us a little bit more about your own personal professional journey.
Yeah. Thanks so much, Jeremy. Appreciate you having me on here. So yeah, I was just kind of born and raised here in Phoenix, Arizona, lower middle class family, had no real estate background, no rich uncle or anything like that. And like most people, I was taught, you go to school, you get good grades, get a degree, get a job. And so that's kind of the path I was on. I wanted to be a football player. And so I had a football scholarship to like a small Division II school, went there for a little bit, realized I wasn't very good, wasn't big enough or good enough to go to the NFL. And so the next thing I wanted to do was be a sports reporter. And so actually I got a journalism degree at the Walter Cronkite School of Journalism, one of the top schools here at ASU in Arizona. And I was actually a live news anchor sports reporter for Arizona PBS for a short time, which was cool at first, Jeremy, be on live TV. And, I thought that would be like what I wanted to do, but I quickly realized I did not like it. Okay. Cause it's just not the same when it's your job. It's not the same as being a sports fan. And I realized you don't make hardly any money in journalism. And, while I was going to school, I was having to work nights and weekends to pay for school out of pocket. And I remember when I was 18, Jeremy, I read the Dave Ramsey book, about financial freedom, about, all about killing your debt and saving money. And so from, all through college, I was really all about like being disciplined, financially disciplined. And, I liked making money. I liked to, be paying off my debt. And so when I was in my early 20s, I graduated journalism. I decided, you know what, I don't want to do journalism because, I can't hardly make any money. It's not what I thought it would be. And I want to just pay off my student debt and get kind of financially established. And so, I decided, of all things, I just needed to make money. So when I was going to school, I was working full-time nights and weekends as like a medical equipment delivery driver of all things. And so I kind of parlayed that into a healthcare marketing job working for a hospice organization. So for those of you who aren't familiar, hospice care provides like end of life, nursing, caregiving equipment for people who have terminal illnesses. And so, it sounds pretty weird, but my job is to wake up in the morning as a hospice marketer and just drive all around Phoenix and like cold call, walk into like hospitals, doctors' offices, assisted livings, and build relationships with, physicians, social workers, nurses. When they have somebody who needs hospice care, they call me. I'm the first person to go meet with that family, educate them, and get them signed up. And so it's all paid for by Medicare. And it sounds kind of weird, but it's an extremely lucrative and competitive private business industry. And Phoenix is like the number one market in the country because there's so many seniors or, geriatric people who move here. And so there's hundreds of hospice companies, there's thousands of marketers. And fortunately, when I was, in my early 20s, I was able to really, become one of the top guys in this space. So by the time I'm 23, I'm making like 150K a year, making more money than both of my parents combined. I bought a house when I was 23. I started going to night school, to business school, getting my MBA at night when I wasn't working. I paid for that with cash. By the time I'm 24, I've got my MBA. I have a house. I have no debt besides my mortgage. And so I was doing well, and I was fortunate. I became a director of marketing. I was managing a team. So by the time I'm 26, Jeremy, I'm making 200K plus a year. I'm pretty financially established, but I was just completely miserable. Okay, because I never wanted to do that. It's not my passion was to do hospice marketing. I was literally just trying to make money, but I felt stuck, honestly, because I felt like I was kind of had the golden handcuffs, because I knew that nobody else my age was making that kind of money. I didn't know where else I could even make that kind of money, but I didn't want to do that, and I didn't feel challenged, because in all humility, I was just dominating my space, just destroying my competition every single month, and it just gets old. It's like, what is the next challenge? And so I remember at the end of 2017, I was just so unhappy. I started reading books, Rich Dad, Poor Dad, the cliche story. That was me, reading that book. And January of 2018, I said, you know what, screw it. I got to make a move. So I resigned. I sold my equity in that company, and I literally had no plan. I just knew I wanted to somehow create passive income through real estate, because I felt like I was trading my time for money, all those years. And I also realized that I think I was fortunate, Jeremy, that a lot of my peers were like in their 40s and 50s. I was kind of unique, right? To be in my mid to late 20s in that position. And I just realized, like, if I stay here, I'm going to be on the path that these people are on, and they don't seem happy. And that's not what I want to do. I want to achieve greatness and do something big. And so I was like, you know what? I just need to get out of this. I need time to think. And I had relentlessly saved. I had almost $300,000 of cash. I had relentlessly saved those 4 or 5 years, following the Dave Ramsey plan, and getting a little pop of equity from selling my equity in that company. And so my plan was to try to figure out how to make money through real estate. And I didn't know anybody in the space. I had never heard of multifamily syndication when I quit the job. I was literally going to flip houses. That's what I was thinking with real estate. And I started researching, and I quickly realized it's transactional. It's the same thing I was doing, right? It's like you're only as good as your next flip. So then I started listening to podcasts, just like yours, going to meetups, networking with people in order to start learning about investing. Because when I quit the job, Jeremy, I had this 300K of cash, which I thought was a ton of money. I felt like a baller, right? I thought that was so much money. But I quickly realized it doesn't get you very far in commercial real estate. And I was trying to like calculate, how can I make this go as far? Like at one point, so this is a true story. I cold called over 90 different mobile home park owners in the Phoenix area, trying to buy one of their parks on a seller carry where I could use my own cash. Hardly any of them answered. The few people that did answer weren't interested. But I was doing the math, and I realized even if I bought one with that seller carry loan, I might make $2,000 to $3,000 of cash flow a month, and then what? I'm out of money. So, a few months into that, Jeremy, I learned about syndication and this whole concept that I can leverage my time and energy to benefit other people and leverage their money. And it's a trade-off, because they don't have time and energy, because they have their busy W-2 job, and I had that. So I was like, this is what I want to do. I want to syndicate deals and, kind of build out a business. And so, long story short, basically it was 14 months from when I quit that job to when we bought the first deal. So I quit the job in January of 18. We closed February of 19 on our first property. And during that span, and there's obviously a lot during that time that happened, but during that span, I met my two business partners, Bikram and Robert. Bikram is now our CFO. He has an economics degree, CPA, worked at PricewaterhouseCoopers, one of the big four accounting firms, for a number of years as a corporate auditor. So very strong financial analysis background. I was like, I know I need an elite finance guy, and that was Bikram. Robert was our chief construction officer. Okay. And so I knew I needed a construction guy. Robert has a master's degree in architecture, strong construction background. And so the three of us partnered up. I met them at conferences during that year. I had never known them before. And we bought that first deal. It was a 36 unit, $3.5 million apartment building in Phoenix. And it was just the three of us, Jeremy, and a couple other people. We had no passive investors. We all put in big chunks of our own money so that we could really learn how to execute this value add business plan and really get, nitty gritty in the details of day-to-day operations and asset managers. So that's what we did. And that was really good to give us the experience and momentum to then go forward and start syndicating these deals. Okay. And so I was able to go to a lot of the physicians I knew, the healthcare professionals, healthcare executives, business owners. Bitcoin had a lot of financial services people who wanted to invest. Robert had his network. His wife is also a physician, so he had a lot of healthcare people. And so, we just started to gain this momentum to continue to syndicate deals. And we realized pretty quickly, Jeremy, that we all clicked and we wanted to build like a truly built out private equity firm with infrastructure. Okay. We didn't want to just be like one of these fly by night syndicators that lives in a different state running this company from our couch with third party management. And not to say you can't do that because most people do, but we were like, we want to be a real company. We want an office. We want employees. We want discipline, accountability. And so as we started to sell deals and make money, make profits, and by the way, we made no money the first 3 years because all of our money was going in the deals, and the preferred return eats up all the cash flow. But as we started to sell deals, we took all of our profits and we reinvested it into the company to build infrastructure. So we first brought construction management in house because we realized that we cannot rely on third parties to effectively stay on schedule and on budget for renovations. We brought property management in house because as we got to around 2,000 units, we're like, hey, we have to have full control and continuity to be able to effectively scale. So we just started to create these other companies and become, vertically integrated and kind of get to where we are now. So, we've just stayed, and I know there's a lot that I just mentioned. I'll stop here shortly, but our biggest focus, Jeremy, I think the reason we were able to scale, because a lot of people say, how did you guys grow so fast? First of all, it's been like 6 years. It feels like 15 years to me because we had so much change. But I think our biggest thing was when I was first getting into real estate, I kept getting distracted. I was looking at mobile home parks, self-storage, multifamily, and one of them would seem good and then it seemed too competitive. So I got discouraged and I jumped to the next thing. Like, oh, you can make money here, you can make money here. And I realized at that point is like, if it's making money and if people are successful at it, there's a reason for that. And it's all going to be competitive. Okay. So you have to really laser focus and dial in. And so I think the reason we've been able to scale is that we specifically only focus on value add multifamily. We don't do development. We don't do any other asset class. I tell people we're very vanilla. We have a box that we stick to and we rinse and repeat the same thing over and over. And so, we started in Phoenix, bought our first 40 deals in Phoenix. We then expanded to Dallas. And those are our two markets now. So that's kind of gives you a little bit of background of kind of how we got to where we are
Yeah,
right now.
I appreciate that, Zach, and that's really good background in terms of how you've been able to scale the business and kind of how you really originally got started in the business, right? I've had the pleasure of talking to literally hundreds of sponsors, in different markets across the country. And one of the things that you said in terms of why you were able to scale the business and have been so successful over the past several years, to me, it's really because you went all in. Okay, you fully bet on yourself. There's not a lot of sponsors in this space today that can truly say that all partners within the sponsorship are full-time in the business. Okay, you are full-time in the business. You literally put all the chips on the table. You all three went full board, all into the business, and from there, you've largely been able to be very successful in it. One other thing that I know about Rise48 Equities is that you primarily like to focus on that B class property, B class neighborhood. So my question for you, Zach, is why is it the B class workforce housing as opposed to maybe a core plus, an A class, a C class, et cetera?
Yeah, great question, Jeremy. Like you said, we like to focus on that B class, type of asset, type of demographic, because and again, we haven't been around forever. So what we try to do is we talk to people who have been through multiple real estate cycles, we look at historical data. And the reality is that the newer Class A apartments, those are a lot sexier, right? They look nicer, they're brand new, they got the fancy amenities. But when we looked historically, like 2008, 2009, when there's a recession or an economic downturn, a couple things typically always happen is that people lose their single family homes. They can't afford them for whatever reason, or they're not buying homes. And those Class A luxury apartment tenants cannot afford those premium rents and they trickle down into this B class space. Okay. So when I tell people we focus on B class, that is basically clean, safe communities that are affordable where the majority of the population lives. And that's the biggest key is that there's really two components is that one, we think in general, B class housing is more insulated in any downturn because the rents are more affordable. Okay. And so you're going to kind of get those people that got a better job and want to move up from like a C class or a mobile home park. They want to live in an apartment. They're going to move up to B class. And you get the people that lost their house, they can't afford a house, or they can't afford class A. They're going to trickle down. And it really is, if you look statistically, where the bulk of the demographic lives. So it's more insulated in different economic conditions. And then the second thing, which is really the most important, is that if we go buy a brand new class A luxury apartment, that property was just built and those rents are at the peak. So first of all, I cannot push those rents any higher because they're already at the peak. And secondly, there's a small demographic of people that can actually afford them. Okay. And your demographic that can afford those premium rents, $3,000 plus a month, they're trying to consider, should I rent this class A apartment or should I just go buy a house? Because that's the type of, thing that they're weighing. With B class housing, we can actually do what's called force the appreciation, which means that we are specifically trying to find and target assets that have rents that are below market and have their old original interior and exterior finishes. Okay, so these properties are typically built in the 1980s, 1990s that have original appliances, countertops, cabinets, etc. And we can go in there and renovate the units to our platinum level scope, which is stainless steel appliances, brand new cabinets, quartz countertops. And so we're basically, we're doing this full interior scope and we're providing a class A luxury interior finish, but it's in this workforce housing type of product, which is still affordable and where the majority of the population lives. That allows us to drastically increase the rents, which increases the value of the asset and gets us that profit margin for the investors. And I always tell people, Jeremy, that and this blew my mind, by the way, in 2018. I knew nothing about this. When I discovered this multifamily, I was like, why is everybody not doing this? Because it makes total sense. Is that these apartment buildings, they are valued like businesses. Okay. So if there's a listener listening to this and you have a house, if the house across the street sells for a higher price, well, then you would think your value of your house goes up, right? Because that's considered a comp or a comparable. Well, that's not necessarily how these apartment buildings work. They are valued based on how much money or revenue are they producing each month and each year, just like a business. So if I can go in there and I find a property, and again, these are a needle in a haystack. These deals are not easy to find. Typically, 2% of the deals we look at actually work for us. So it's a volume game. But if I can find a property that has, poor management, they're not collecting as much rent or pushing rents like they should, I can renovate those units to increase the rents. When I increase the rents, I've increased the revenue and the property will sell for a multiple of that revenue. And so, it's more insulated just because of the fact of the demographic and the affordability, but it's also more insulated because we are not vulnerable to organic rent growth. Okay. So in Phoenix and Dallas, the last 12 to 24 months, there's been negative organic rent growth across the entire country, really, as all this new supply of apartments have come online. Inflation has caught up to people. COVID stimulus checks ran out. Rents are going backwards. Well, we've still been able to renovate units and get significant rental increases. We're averaging between $300 to $450 a unit of our rental increases during this downturn because we were finding deals that already had rents below market and we're just bringing them up to market. And so, there's multiple reasons why we can do it. And I tell people that, with this B class space, we feel like not only are we more insulated during the down periods, but when the market is hot, okay, and you're in these high growth periods, this is where you get the better returns too. It's kind of like a win-win from our perspective. And so that's kind of why we focus on this niche.
Yeah, no, that makes sense. And I appreciate you explaining that. One other thing that I know that is somewhat of a competitive advantage, I would say that you have, in the private equity real estate space is your vertical integration. So vertically integrated on both the property management side, the building construction side. Can you speak specifically to the audience about maybe why you made that decision to go vertically integrated and why it really is necessary, for you to continue to scale Rise 48?
Yeah, absolutely. So to give you an idea, Jeremy, like to be 100% honest, when I got into this, we thought we could just buy a deal, throw a third-party management company on there, and then sit back and collect the rents. And that's what everybody says you can do. And we were using third-party management initially, but if people remember, at the end of 2020, early 2021, kind of coming off the heels of COVID, across the country, across multiple industries, nobody wanted to work. Okay. And we saw it especially prevalent in property management. Okay. And so at that time, we were getting to around 2,000 units. We were starting to get some scale. We were starting to grow. And we had a third party property management company. And within a 5-month span, Jeremy, 4 of our assets had the on-site manager leave. They got poached or picked off by another property management company. Like other property management companies would literally just show up on site, offer them more money, and they would leave. It was like a labor war. And the reality is, for people who don't know, property management is a crappy business model. Okay. It's very low profit margin. You don't make a lot of money off of it. And for these third party property management companies, which is probably like 90% or more of operators use third party, they don't have their own management company. If that is your business model is property management, then you have very thin margins and you simply cannot afford to be as competitive with compensation, okay, to attract the best people and to keep them. And so it was a labor war across the entire market where people will literally leave for $1 more an hour or whatever it may be. And so we realized quickly, like, you know what, we cannot have this. We need to have continuity. We need to have full control, especially as we continue to scale. And so we decided to start our own property management company with the idea that we will offer the most competitive compensation in the industry, the best benefits to not only recruit, but to retain the best talent. And that's what we did. And so basically we have over 250 plus full-time W-2 employees. We cover 100% of every employee's medical, dental, vision. We cover 50% of their dependents. We have a 401k program. We match 3% of their contributions. And so we literally have the best benefits in the industry that we're aware of. Okay. We haven't heard of anybody else. And we're constantly, now we are the ones poaching people. Okay. And I mentioned in my W-2 journey as an employee, the whole golden handcuffs. Well, I'm just going to be honest with you. I'm trying to golden handcuff my employees and I want them to be happy. I want them to like the culture, of course, and be happy with what they're doing. But I want them to know you can leave us, but you won't make more money or better benefits anywhere else because we want the top performers. And it's just kind of crazy. Some of you guys have probably heard this saying that you have somebody who's making $60,000 to $65,000 a year, meaning a property manager, running a $50 million asset. Okay, that's the reality of this. And the property management labor pool is mostly entry-level employees, right? These are people. So it's all about getting, people who have good attitudes, people who are hardworking, people who fit your culture. And so bringing property management, there's a lot that went into it. It's a pain in the butt, honestly. Like, to give you an idea, we invested $800,000 of our cash into that company. It took about 10 months to break even, and then it did become profitable. But I tell people, when you start a property management company, that is when you have started a real company in this space. Okay. Because if, you could have like your investment company, have a handful of employees, that's easy. When you have a property management company, it's this whole other realm now you've gone into, Jeremy, where basically you have, you need to have an HR department. You need to have employee handbook. You need to have policies and procedures. You need to be aware of all these different things. And we're extremely grateful we did it in 2021 when we did, because as interest rates went up in 2022 and the market started to soften, a lot of these operators that have third-party management companies right now are getting crushed. And it's just because they don't have control. And in 22 and 23, we really strengthened our operations significantly. And we basically, it just gives you more autonomy because you got to be a killer in this space if you want to survive, if you want to do well during these downturns. And so it allowed us to incentivize and reward top performers. It allowed us to terminate quickly anybody who's not performing. And the problem was when we had third-party management, Jeremy, is that on a couple of these assets, we would have an on-site manager who was not performing. They're not leasing like we want. They're not doing a good job. And we'll complain to the property manager company over and over. And property management is thankless. Okay. They're constantly getting beat up by the owners, and they are professional, they're professionals at absorbing these complaints, because this is all they just get beat up every day. So they'll just tell you, yeah, we're sorry, blah, 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 but they don't fire the staff because they can't replace them. Well, we're like, we can't have that. If we need to cut somebody, we need to cut somebody. And so, that is the benefit too, is that we have full autonomy over staff, or maybe this person has really great leasing skills for this demographic, but it's not fitting this asset, but we believe in them. Let's move them to this other asset. Let's have this, autonomy. So there's so much that goes into it as far as, structuring incentive packages, bonuses to, really make sure that you're meeting the goals of the asset and the team. And so it's really been kind of like our secret weapon is having property management and construction management in-house.
Yeah, no, that makes sense. I appreciate that. For me as an investor, I see it as a huge risk mitigation piece to my own personal investment because I can only imagine the type of disruption, that it would be caused at the property level. If you had to terminate a property management company that was third party, as opposed to just maybe needing to terminate, a bad apple employee. So really appreciate that and you sharing that. My next kind of question I want to pivot to is really just to spend a few minutes talking about the debt side and the way that you guys structure your debt. I know primarily most of the loans that you do are floating rate bridge loans. Why is that the strategy as opposed to maybe more fixed term agency debt?
Yeah, good question, Jeremy. And so, yeah, I think, as interest rates have gone up in 2022, a lot of people say, hey, you should be doing fixed rate debt no matter what. And give people some context, we've done a variety of these different types of debt structures over the years. So we've done 10-year Freddie Mac fixed rate debt. We've done 10-year Freddie Mac floating rate debt, and we've done these debt fund bridge loans. And we've sold 11 deals, by the way. So we've gone full, we've acquired, executed the plan, and sold 11 different assets. And we've sold all three types of those loan products that I just mentioned. So we know the pros and the cons upon acquisition through operations and disposition of these different debt products. And we actually, I tell people, Jeremy, we made the mistake of using fixed rate debt on two of our very first deals. And I'll explain why it was a mistake. And at the time, we were like, why wouldn't you do fixed rate debt? It's a no brainer, right? Why would I take the risk of floating rate debt? So two of our very first deals that we did were 10-year Freddie Mac fixed rate debt. We felt really comfortable because our rate can't change for 10 years. What a lot of people don't realize is that whenever you take a fixed rate loan, whether it's Freddie Mac, Fannie Mae, a bank, whomever, that lender has a lot of exposure on their end because with a fixed rate loan, they are guaranteeing you that you, the borrower, that your interest rate will not change. Well, if interest rates go up in the market like they have the last 24 months, for example, the lender has a lot of exposure there, okay? Because they're typically taking a loan from somebody else and moving money around constantly as a lender. And so the way that they protect themselves as a lender when they hit you, when they give you a fixed rate loan is they hit you with a really nasty prepay penalty called yield maintenance or defeasance, okay? And so, for example, if it's a 10-year loan and you want to sell a deal in year two, you're going to pay that lender an additional 8 years worth of yield that they would have made, yield maintenance. And so we learned this the hard way. We bought a deal in 2019 for $17 million in Phoenix. It was a 10-year Freddie Mac fixed rate loan. We did a great job in the business plan. 2 years later in 2020, we renovated over 50% of the units, drastically exceeding our pro forma rents. We go to sell the deal and the lender says, okay, you have a yield maintenance prepay penalty of $3 million right off the top. $3 million of cash out of investors' pockets. And we're like, oh crap, we were doing the calculations and we had to actually hold the deal for 8 months longer, continue to renovate to increase the revenue, increase the NOI, just so that when we sell, we have a higher value to absorb this massive prepay penalty and still net out investors a 2x return. And we were honestly, Jeremy, we were lucky the market was strong because if it wasn't, we probably wouldn't have been able to sell the deal. And so what people don't realize is that this massive prepay penalty can impact the net return to your investors when you try to go to sell the deal. And it also can prevent you from doing a refinance. The reason we do floating rate debt is that we have no prepay penalty, okay, for these deals. And one thing I'll mention about yield maintenance too, it's impossible to underwrite it in your model, okay, because it literally changes daily. Okay, just like the stock market. And so you don't know, first of all, when you're going to sell the deal. And even if you could say, I'm going to sell 3 years from now on the dot, you don't know what yield maintenance prepay penalty will be on that day. And so you cannot underwrite it in your model and you cannot account for it. And as interest rates go down, yield maintenance prepay goes up. There's an inverse relationship. Okay. And so the reason we do floating rate is that we have no prepay penalty. And so that we can truly underwrite that into our model and not have to worry about that and maximize our returns to investors upon a sale or a refi. It also gives us maximum flexibility to adapt to changing market conditions, to do what's best for investors. And the way we mitigate against that floating interest rate risk is we buy a low in the money interest rate cap up front. So we're buying 3-year interest rate caps where we're basically making sure that our all-in max rate is 4.75% day one for the first 3 years. Okay, so it cannot exceed that. So we are effectively engineering a 3-year fixed rate loan by buying a low cap up front. And then we're making sure there's significant positive cash flow day one. Okay, and then in our model, we're assuming, or we're making sure in our model that at the end of year 3, once that cap expires, our NOI and our DSCR is high enough to qualify for a refinance if rates have not come down from where they are now. Okay, so basically, we've learned from trial and error, the best type of debt product to put onto these deals and what makes the most sense for investors.
That's great. I appreciate you sharing that. Zach, this has been a tremendous conversation. I really appreciate you joining the Freedom Point podcast today.
Yeah, thanks so much, Jeremy. Really excited to be here. Appreciate you having me, and we'll talk to you soon.
Absolutely. And listening audience, thank you again for jumping into another episode of the Freedom Point podcast. We look forward to having you join us on the next episode.
Thank you for hanging out with us today and for listening to the Freedom Point podcast, powered by Starting Point Capital. This show is for entertainment purposes only. Nothing said on this show should be considered financial advice. Before making any financial decision, please consult with a professional. This show is copyrighted by the Freedom Point podcast. Written permissions must be granted before syndication or rebroadcasting. If you're interested in connecting, you can find contact information at startingpointcapital.com.